Chairman of the branch, CA Macharao Minavalli. Our speaker of the day, CA Naga Durga Sudhakar sir. Friends, we all know that today topic is Ind As 115 revenue from contract with customer, and we have the learned speaker who is already arrived 15 minutes before only, ahead with our schedule. Thank you, sir.
Thank you.
May I now request Chairman Macharao Minavalli sir to kindly give the introductory remarks.
Thank you, Deepak. First of all, I thank you so much, Sudhakar, who is my friend from my childhood days, and I love to see you at this position. Really, I'm admire of your hard work, dedication towards your particularly job or commitments, and reached very great heights in our profession and employment. Really great issue, great thing for me, and really happy news for me.
Thank you. Thank you.
Respected members of Hyderabad branch and learned speaker of the day today, Sudhakar sir. And good evening and a warm welcome for today's webinar, particularly Ind As. I personally know Sudhakar is having a very good exposure and experience about this Ind As, and he used to take classes not only for Hyderabad branch, used to take classes entire pan India. Also supporting the members by taking a lot of classes for the members and students also. So great resource for an ICA as a whole and supporting members and students. And his favorite core area is IFRS and auditing and accounts, and is from the beginning in that area only. Even we, Deepak, for your kind information, Sudhakar and myself are roommates. And here it's not there in his profile, but he's an All India ranker in the Chartered Accountancy course and a very intelligent fellow. Sudhakar, very love to see you here and very glad to see you. I'm really pleasure to see you as a speaker again when I'm chairman for Hyderabad branch. And,
thank you.
Thank you so much for joining here. And I request you to take a series of sessions on IFRS. That's what Deepak and myself is planning for the last 1 year. I'm also discussing with you due to some lack of time for you. We could not able to do it, but a lot of members are requesting particularly a series of sessions like Saturday or Sunday or Friday, Saturday, 2 days a week. And what are the very important Ind As which are required for the members? I request you to please design and let us plan a program, and we will take a series of the program on Ind As.
Definitely. In fact, you have been asking it for quite some time. It's in fact pending from my side, in fact, to give you at least those details. In fact, I agree. It's pending on my side, basically.
No issue. Thank you so much. And I thank all the participants and delegates for joining this program. And I request you to request your active participation. And your active participation will only encourage us and motivate us to organize and more programs. Thank you. Over to Deepak.
Thank you, sir, for introductory remarks. May I now request, sir, Chairman sir, will you introduce the speaker? Because it will be your privilege to introduce your counterpart. That's why I don't want to take this opportunity from you.
If given a chance, given a chance, I would directly get into the presentation rather than any, because he has already spoken very highly of me, which I don't know, myself don't know whether I have achieved or not, kind of stuff. So.
Sudhakar, I know it's from our room time and I know all your things.
It is so kind of you, sir. But I request Chairman sir to kindly give a formal introduction.
Thanks, Deepak. Thanks. Friends, Sudhakar is presently Director of Finance in the Dr. Reddy's Laboratories and is a Chartered Accountant who is in employment. And Naga Durga Sudhakar GV is working in Dr. Reddy's Lab from May 2011. And March 2011, he worked as a Senior Lead Manager in Bharat Financials Inclusion Limited, formerly SKS Microfinance Limited. Before that, he worked in KPMG almost for 5 years. He's a qualified chartered accountant with more than 15 plus years of experience in the fields of accounting, auditing, and very interesting. An IFRS is a very favorite topic and is practically working on that from the last 5-6 years. Am I correct, Sudhakar? And I think more than that. You are into IFRS?
15 years. For the past 15 years.
Currently working as a Director of Finance in the Global Financial Reporting team of Dr. Reddy's Laboratories Limited. Before joining Dr. Reddy's, he worked in Operational Risk Department in SKS Microfinance for a year. Before that, as I discussed with you, he worked in a statutory audit division in KPMG for 5 years. Other honorary positions, ICA is recognized his wonderful efforts and support for an ICA and presently is a technical reviewer in the Financial Reporting Review Board (FRRB) of an ICI, resource faculty of Indian Audit and Account Service in Hyderabad, resource faculty for an ICI in imparting training as a part of the Ind As certification course, Hyderabad, Chennai, and Bangalore. Not only certification course, he regularly takes the classes for students and members pan India. Sudhakar, thanks for your contribution to ICI. Really, you're a motivator, and thanks for joining today with us.
Thank you. Thank you. Thank you. Thank you. Thank you. So should I start?
Yes, sir.
Please, sir, skin is yours.
Yeah. So is my screen visible?
You can do slides,
Yes,
sir.
Yeah. I'm shifting to.
Deepak, can you? Someone has raised the hand. Can you lower the hand, please? Because I could not able to do because I'm operating through that.
Yeah.
Now, okay, Sudhakar.
Yeah. Okay. So I can start right now. Yeah. Thank you. Thanks a lot. Very short. My name is Sudhakar. I'm just a chartered accountant. Forget about rest of the introductory part. Yeah. First of all, thanks a lot for the opportunity that has been given to me. Okay. Given the paucity of time and the topic that I have chosen, I would straight away get into the topic because we hardly have 2 hours of time. And predominantly, just to give you a disclaimer, when whatever the presentation that has been circulated to you in the form of PDF or whatever that is going to be presented to you is predominantly a presentation which I personally keep using it whenever I take lectures for Ind As certification course in ICI. Just to give you a backdrop, that course requires this particular trainer to take this session almost for 6 to 7 hours. It's a day-long course. So I have used the same presentation. So definitely the content is more when compared to the time that is being currently we have or whatever that is being offered. That's okay. Given keeping all these nuances aside, let's get into the topic very fast and let's try to understand what exactly this accounting standard is all about with some illustrations and in-depth some of the examples. So anybody who is listening to this particular presentation for the first time or to the topic for the first time, my humble request is, try to get the grasp of the accounting standard. Don't try to think that, okay, in the next 2 hours kind of a thing, I'll be able to deep dive into the accounting standard or I'll be able to solve a particular practical position that is being, by dealing with this particular accounting standard. So I would rather say for the next 2 hours, we'll be having a greater in-detail discussion about revenue accounting standards. With respect to all the parameters that have been touched upon in the accounting standard. Okay. Before getting into the topic, I just want to give you a brief, very short brief about how a particular accounting standard has first come into picture. Okay, keeping aside, Ind As as such, whether we like it or not, one can trace back the basic or roots of accounting standards to United States. When once AICP has first started their accounting research bulletins. Later on, I'm directly jumping the gun, it has moved to United Kingdom. So United States had one accounting body and UK had one accounting body when it comes to prescribing accounting standards. India, for reasons known or unknown, or whether we like it or don't like it, always chose to select some of the areas from United Kingdom, be it constitution or be it, although it was unwritten for them, the manner in which Companies Act was written or the manner in which income tax was chosen, Contract Act, similarly accounting standards. We chose that we would take, although United States gap was there and UK gap was there, that we will consider predominantly that particular gap prevailing in UK. So when we first initially wrote the accounting standards, that so-called old accounting standards, it was the then existing international gap in United Kingdom. But later on, we couldn't upgrade our own accounting systems or standards with the same pace with which that particular bodies have chosen. Later on, the gap has increased, and we chose that, okay, we will now remove the gap by entering into this convergence program and all that stuff. Keeping the manner in which the gap has come or has evolved to India, keeping that aside, what has happened abroad is, for some reasons, these two bodies have come together, have decided to come together and decided to issue accounting standards under the one aegis and under the one name. Practically speaking, I would say, although business combinations was one of the more closer accounting standard between US GAAP and UK, I would say revenue recognition in the form of Ind As 115 or so-called IFRS 15 or ASC 606 was the first theoretically formulated converged accounting standard across the globe. So both the accounting standard bodies have come together and has written one accounting standard for revenue for the whole world altogether, keeping aside some of the local accounting bodies that would dictate. So predominantly, it's a single accounting standard. Later on, they had their own differences in interpreting whatever they have written. Again, there were differences between the two bodies, and the interpretation again differed. So what I am trying to say is, it's in fact one of the converged accounting standards in the whole world between IASB and US GAAP kind of stuff. So the same thing we have predominantly adopted, but for a few differences in paragraphs. Technically, to say that 51AA, where penalties, how the accounting for penalties has to be done, is a little carve out when it comes to Indian accounting standards. Now, coming back to our position, yeah, and when this particular accounting standard and accounting standard has first been made applicable, on 28th March 2018, MCA has notified that all the entities have to now follow, to which Ind As is applicable, they have to now follow Ind As 115, which is revenue from contracts with customers. Although it's only a 3 days gap, 28th, 29th, 30th, and 31st, basically from 1st April 2018 onwards, this particular accounting standard comes into picture. And it has superseded 3 literatures when it comes to revenue. Ind As 18, revenue from other contracts other than construction contracts. Ind As 11, which specifically deals about construction contracts. And there was some guidance note issued by ICIA for real estate transactions. All these 3 guidances have now been superseded, and from 2018 onwards, it is Ind As 115 that predominantly rules the entire Indian accounting world when it comes to revenue recognition. What is so typical of this one particular accounting standard versus the 3 accounting standards? Just to give you a small brief, 11 was dealing with construction contracts, 18 was dealing with other contracts. So when some real estate guy or infra guy was predominantly looking at this standard, he predominantly goes to Ind As 11. He never used to come to Ind As 18. Similarly, other readers used to refer only Ind As 18. Now, because it's only one accounting standard, the catch here is you need to know which particular line item is predominantly applicable for which type of an industry. Because infrastructure, pharmaceutical, telecommunications, these are little specialized industries. Obviously, you should know what sort of an example more aptly suits and what sort of a guidance more aptly suits which sort of an industry. So to an extent, I found it little difficult when I was first reading the bare accounting standard, when this has to be implemented in my organization. Later on, by number of readings, I finally came to a position that, okay, there is some challenge here when we are picking up the examples and when we are picking up, okay, whether this is applicable or more apt and more applicable for other industry kind of stuff. Okay, what is the reason for issuing this particular accounting standard? There was in Ind As 18 and Ind As 11, there was a little bit of obscurity with respect to what is the accounting for various topics like multiple deliverables, and what is the accounting for consideration when it is paid to customers. There is no clear guarantee as to what sort of constructive obligations would become performance obligations, and warranty costs accounting is not very detailed. Similarly, allowance for sales returns. No, although the language little got changed, but predominantly allowance for. So there are certain pointers which were to an extent left to the judgment of the reader or to the entity when Ind As 18 and Ind As 11 were so-called applied at that point in time. Now, Ind As 115 completely removes that obscurity, and this particular accounting standard gives you a complete detail about whatever the topics we have so far have discussed. Now, if you see Ind As 18, to an extent from comparison point of view, because the major accounting standard being Ind As 18, I'll just compare that particular accounting standard with Ind As 115. If you see, the accounting standard predominantly started with objective, then scope, definitions, recognition, measurement, and presentation and disclosure kind of stuff. In recognition, you must have seen 3 types of revenue streams under Ind As 18. What are they? Revenue from sale of goods, revenue from service income, and income from use of enterprises assets by somebody else. Means you call it interest, royalties, or dividend from use of entities assets. There is no such differentiation when it comes to Ind As 115. Ind As 115 does not specify what category of revenue and what sort of recognition criteria need to be applied for that particular category of revenue. If you see Ind As 18, sale of goods has its own revenue recognition criteria. So is the case with service income and use of enterprise assets by others. Means I'll be keep using the word license fee. So for sale of goods, service income, and license fee, the recognition criteria have been detailedly dealt with and have been specifically dealt with. But Ind As 115 does not go by that demarcation. It says only one thing, boss, you need to apply a 5-step model if at all you want to decipher or understand any accounting position or any accounting agreement you have entered into with the customer. Ind As 18 defined revenue. Ind As 115 defined customer. Just to, I'm not here basically explaining, my objective is not to explain the differences between the 2 standards, but just to give you bring you to the platform that the focus is whatever the contract you have with customer. Now you need to understand the entire contract and analyze the entire contract using the 5-step principle. Using those 5-step principles, you have to deal with any contract that you are entering with the customer. Now, let's understand whatever the 5-step models is. While of course we will be dealing with, of course, these 5 steps only in detail for the subsequent portion of the session. Let's see. I mean, it first says that, okay, identify the contract with customer. Whatever that is there in the brackets is the reference of the paragraphs that have been used in the standard. Now, only one catch here is, I mean, if you have, anybody has referred to the main bare accounting standard, not anybody's literature or whatever the document that is available in Google. If you refer Ind As 115 as such in the bare accounting standard mode, see 9 to 21 deal with identify the contract with customer, 22 to 30 deal with performance obligations, fine. But after that, see the last point, 31 to 46 is step 5. So when you are reading the flow of reading the accounting standard in its normal flow, you will end up having the 5th step reading in between while you still have to understand step 3 and step 4. So predominantly, I would suggest those who are reading the bare accounting standard, try to change the order. Don't read paragraphs 31 to 46 initially. Try to complete the transaction price and then allocation of transaction price and then come to recognition. Because the accounting standard has to be kept in that so-called mode of recognition, measurement, and presentation and disclosure. They have brought the 5th step into that picture. So the 5th step typically comes into a 3rd step kind of a step when you are reading the accounting standard. Of course, these are all administrative nuances. Now we can get into, let's get into the main position as such. Okay, we have understood that this particular accounting standard is applicable from 1st April 2018. And what are the, whenever a new accounting standard comes into picture, we know that it is Ind As that comes into picture. What is the manner in which this particular accounting standard has to be applied when it comes to, previous periods? Can I still go with the old accounting standards, or is it a new accounting standard that needs to be applied? The leeway that has been given is, given the voluminous nature of this particular accounting standard, and to an extent the complexities associated with it, the accounting standard gives us, two modes of applying this particular accounting standard. Either full retrospective approach, where taking 2018 April as a base, this is how your numbers would look like. So your current year number would be completely Ind AS 115. Previous number would be Ind AS 115 if you choose to apply full retrospective model. If you choose not to apply full retrospective model but with practical experience, it is mixed requirement. No, I just want to go with the cumulative catch-up approach. My previous number, so-called 2017 P&L number, would be Ind AS 11 or 18. My 2018 number would be Ind AS 115. Same is the case if at all you want to go for 2020 or any company, new company that for which you are recently applying the accounting standard, it goes in the same form basically. I don't want to spend too much of time on these effective date and transition approaches that are available. Let's get into scope part of this particular standard. As I said, this particular accounting standard is applicable for all the contracts with your customers. So first and foremost, one needs to define whether a particular party is my customer or not, for which we will see the definition of customer and the position, or at what points in time a particular party would be a customer and what points in time he will not be my customer. So it's applicable for all sorts of agreements with customers. But even with customers, there are certain transactions which are outside the scope of this accounting standard. What are they? Leases. Very clear why this particular standard is not applicable here, because there is Ind AS 116 that is specifically applicable for leasing transactions between the parties. From a lessor's point of view, a leasing transaction is still a revenue transaction. So although lessee is his customer, you can't apply Ind AS 115 principles there. That's the reason why a leasing transaction has been scoped out. What do you mean by insurance contracts? How come an insurance business can have both revenue contract or can have an insurance business? Just to give you a small example, maybe I can relate it to one of the examples which I always quote whenever I am taking the lecture. See, you must have seen one advertisement of Samsung mobile phone where two men will collide in a party and both the mobiles will fall down, and one of the person's screen gets broken and the other guy asks, oh, is it Samsung hai kya? He says no. Then he says okay. He just gives a sigh and then he moves on. Then the advertisement comes. The first screen or the first two screens will be freely replaced by Samsung. Now look at the business of Samsung. Samsung is not into the business of replacing your screens. He is very clearly within the limited framework of what we are discussing now. He is into the business of selling mobile phones. So a person who is selling the mobile phones is also offering you an indemnity of replacing your screen for the first time or first two times. So his contract with customer also has an insurance component. So now Samsung has an option either to account for that particular transaction under insurance business if specific characteristic features satisfy, or he can choose to consider this particular transaction under Ind AS 115. That's the reason why specifically insurance contract has been selected here under the scope to say, boss, if a particular characteristic features are included in your contract with customer, please consider it as part of revenue. If they are not there kind of stuff, please consider it as part of insurance contracts under Ind AS 117. It hasn't yet come fully. It is still under 104. Okay, now financial instruments and other contractual rights and obligations. Must be wondering, how come Ind AS 109 and Ind AS 115 can at any point in time collide, so that one has to specifically tell me that Ind AS 115 is not applicable for these kind of transactions. When somebody says financial instruments, generally our understanding goes to some debt instrument, some equity instrument kind of stuff. It need not always be debt instrument or an equity instrument or a preferential share. A financial instrument is as simple as our trade receivable. So sometimes there is a little bit of confusion that arises. We may not be able to decipher better whether it is a revenue transaction with customer or is it a financial transaction with a party of the financial instrument. Best example, credit card fee by a banker. Now, credit card holder is a customer to a banker. So whatever the he pays annually, is it a transaction with customer or is it because credit card is a financial instrument? Is it a transaction under Ind As or not? Fine. I'll stop with the question. Later on, you can think through. So you can basically build on what sort of transactions are in and what sort of transactions are out. Non-monetary exchanges between the entities in same line of business. Similar language was there even in the scope paragraph of Ind As 18, but it uses similar nature and value. Predominantly, this requirement has come to curb some of the transactions that are done by, in a way, oil industry. In very explorative industry, it's pretty easy that to cater to the customers more, there can be barter transactions between the oil companies. And similar transactions can be seen even in advertising industries. When these kind of barter transactions happen, that means you please exchange the oil at a particular to a particular customer in that particular country, and I will transfer whatever the value of that oil to your subsidiary or your associate here in this country, kind of stuff. So there are certain non-monetary exchanges between the transactions. They are scoped out. Now, there are certain consequential amendments because of Ind As 115 to some other accounting standards. Most importantly, Ind As 16, which talks about property, plant and equipment, Ind As 38, which talks about intangible assets, have seen some change in the manner in which the derecognition of intangibles and derecognition of property, plant and equipment happens. See, if you were to see, entire Ind As has two pillars. When it comes to recognition, everything goes by control. When it comes to measurement, predominantly everything goes by fair values. See the language that is used. For IA 16, you can recognize a property, plant and equipment when you obtain control. Same is the case with intangible asset. Same is the case with business combination. An acquirer obtains control of a business of the acquiree. It's a business combination. Same is the case with consolidation. The word used is control. Same is the case with revenue recognition. It is not risks and reward based accounting standard anymore. It is a control based accounting standard. I repeat, Ind As 18 was risks and rewards based accounting standard. Ind As 115 is a control based accounting standard. It's predominantly control that determines whether you have ability to recognize revenue or not. It is not about risks and rewards that have been transferred and reward that has been obtained. So it's no more inventory risk, price risk and all that evaluation. It's more about have you transferred your control or not on that particular product or service to the other party. We'll get to see what is the difference between these and once we move forward in this accounting standard. Similarly, when you want to derecognize property, plant and equipment, you have to derecognize the property, plant and equipment in the same way you would derecognize or you would recognize a revenue transaction. Say, for example, I sold a good to him. Did I lose control? Yes, you can recognize revenue. Use the same principle to evaluate. I sold a property, plant and equipment. When should I derecognize? If this were to be your revenue transaction, when would you recognize revenue? In the same manner, you should derecognize the property, plant and equipment. Same is the case with inventory. Especially out of my experience in pharmaceutical industry, there are certain transactions which you might fall in this kind of, this is a slippery ground, especially if you sell a plant. And say, for example, I am also giving you some support services for proper running of the plant for 2 years, for 2 years or 3 years period of time. So when any sale transaction is backed up by some support services or some additional functions that are to be offered or services to be offered by the seller, yeah, I won't say it is not a case of derecognition, but yeah, this is definitely a case that needs to be evaluated under the revised principles kind of stuff. Now, coming back to the main position. As I said, the accounting standard is applicable for all the contracts with the customer. Now, there is an imperative need to define who is a customer. Customer is any party who has contracted with the entity for the purpose of obtaining the good or a service that is the ordinary course of business of an entity. So to say, he defined the same revenue word and more or less customer word in its respective sense. At the end of the day, what is it that you are dealing in? Dr. Reddy's deals in sale of pharmaceutical products and services relating to pharmaceutical products. Airtel is predominantly into business. It's not about what you can do as per your articles of association, what you have been doing and what you would generally be your ordinary course of transaction. So if am I selling in data, or am I selling in product, or am I interested in rendering software services? So there is a framework that defines basically what is it that you are doing, and if that particular party is asking for whatever that you are supposed to or whatever you have been doing for quite some time, that guy becomes our customer. Is it always the case that other guy will be my customer in always all the circumstances? May or may not be the case. If you follow the next example, which I have highlighted in blue color, fine. There the example is about internet-based advertising services company. I'll just change the example and I'll flip the example to Make My Trip kind of stuff. If you go through Make My Trip site, obviously Make My Trip is a platform provider. He brings travelers and he brings the entities that are providing services to travelers, either all these flight runners as well as all these hotels. He does not own any flight, he doesn't own any hotels, but he actually brings these two people here. So depending on his position, say sometimes Make My Trip, let's take an example of a hotel booking. Make My Trip enters into a time sharing arrangements with some of the hotels and he brings those prices to your customers. At that point in time, the customer is not the traveler. At that time, the customer is the party to whom he is rendering the service. For sometimes during peak seasons like December and or sometimes during the traveling period of somewhere October and November, he might purchase literally those spaces all by himself and he can decide on his own whatever the price at which he wants to sell that particular space to customers. At that point in time, his customers are travelers. See, whenever he is behaving like a principal where he is procuring the space from the hoteliers and he is selling it to customers, the customers are the travelers. Where he is only providing a platform, the customers are the companies. It's like the hotels, the Leela Palace, or all the other hotels will basically be the customers to him. So the word customer needs to be understood from the manner in which the business is being conducted by that particular person. It's not that for my own business, always my customer will be one and the same. Take the same example, our MedPlus kind of stuff or Practo kind of a thing, or for that matter, Amazon. They are only the platform providers. It is not that where he is deciding, I have the decision to say, okay, boss, I want to purchase this particular product from so-and-so vendor. So for Amazon, the customer is that vendor. Where on $1 billion day or where on Indian sale kind of stuff, wherever on a particular day, assuming Amazon picks up the entire stock and he takes the inventory risk all by himself. Maybe customer will be the party who is purchasing the product from Amazon. So it differs. You need to see it from contract to contract basis. Is it so in all the kind of arrangements? May not be the case. There are certain transactions there you need to have more and more focus, collaborative arrangements. Sometimes your collaborating partner, maybe your R&D partner, where you need to assess the transaction under Ind As 111, or he might offer certain services to you as a vendor, or you will become the customer. So the collaborating partners might, in the whole collaboration arrangement, for some point in time, they might behave like customers and vendors. and for some point in time, they might behave like collaborating partners. As I said, you need to go more and more into the agreement to understand what exactly is the position between the two parties. The moment you establish that the other party is customer, this particular accounting standard kicks in. And the moment this accounting standard kicks in, you have that 5-step model that needs to be analyzed. Just an administrative update, I will basically not taking any questions till the time I'll stop my whole session. As I said, given the paucity of time, because we have only 2 hours of time, and at least from content point of view, and going by my reputation of busting out my timelines regularly, very possible that I might jolly well bust out the times even now. That's the reason why I am trying to keep my flow in a particular tandem, and I will take up the questions once I complete the whole session. Yeah, for the time being, given the paucity of time, I'm saying I'll not explain much about the interaction with other standards with any example. Whenever any transaction has interactions with other accounting standards, meaning, say for example, I sold goods or I offered certain services in lieu of investments in another entity. So typically the entry is investments account debit to revenue account. Now which entry or which number has to be decided first? Accounting standard is pretty clear. Ind As 115 takes backstage. First apply Ind As 109 and decide what will be the value of the debit under Ind As 109, investments value. Put the balancing figure to Ind As. Now slightly complicate. Not complicate, slightly change the example. There is nothing called complex accounting standard in my view. So coming back to that, I have sold some goods, I have rendered some services, I have taken one intangible asset, and I have taken some investments. Investments account debit, intangible account debit to revenue to inventory. Because there is nothing called inventory kind of stuff, or again you will put again revenue standard. Now there is intangible also. That means intangible has been exchanged for a non-monetary transaction, right? Now there is some guidance that is given under Ind As 38 to deal with non-monetary exchange of intangible assets. First apply that particular position. Then apply Ind As 109 for those two. Put the balancing figure to revenue. That's how it has to be done. Now, coming to the real accounting position, identify the contract with customer, step 1. So coming back, just a small recapitulation of so far whatever we have discussed. We have dealt with a particular, we identified a particular agreement with a particular party. Now we deciphered and we analyzed that the other party is my customer. So you have a piece of paper with you right now, which you need to analyze. How does revenue be accounted for or would be accounted for as per the new accounting standard? So the first and foremost thing you are trying to analyze. So you have passed the position that whether he is a customer or not. Now he is our customer, but whether the agreement with that particular customer constitutes, or whatever the paper I have with that customer, whether it constitutes a contract with the customer as per step 1 or not. It is not contract as per Contract Act, or it is not any other evaluation by any other accounting position. It is whether there is a contract with my customer within the framework of this particular accounting standard or not. So you entered into some terms with a customer. Now whether those terms become any contract or not as per the customer or not. So the first and foremost thing is you need to evaluate. Just give me 1 second. Yeah, fine. You need to evaluate whether this particular party, whether whatever the terms that have been agreed upon by the customer or with that other person becomes contract as per my accounting standard or not. Just give me 1 second.
Any issue, sir?
Nothing. Just a second. I am getting some official. Can you give me 1 minute? I'll just.
Sure.
Just give me 1 second. Yeah, sorry, apologies, my sincere apologies. I've been getting calls, so that's the reason why I thought let me first attend that first. Okay, now coming back to the point, when we entered into certain terms with a particular party, the so-called customer, whether those terms become contract as per the accounting standard or not is the first step that needs to be evaluated. For that purpose, accounting standard gives us some guidance. What is it? So first he says is whether the terms that you are agreeing with the party can be written, they can be oral, or they can be implied. Written contract, there is no need for additional explanation here. It can be a PO, it can be an agreement, service order, or a work order, or whatever it is. You have agreed with the party in writing something which is tenable as per a court of law. That is the most important thing. It has to be tenable in a court of law. It's not that something, okay, we just agreed something and it is not contractually or it is not legally binding on the parties kind of stuff. Second, are there any oral contracts possible? Just to give you a small example, predominantly these kind of contracts would be there in internet, security services. Not security means the system security services. Or in financial services industry, sometimes you must have, majority of you guys in most of the times you must have experienced, whenever you want to do any phone banking business or whatever it is, you can actually do certain deals even with the banker. So what does he say? He said the call will be recorded for future training purposes or for operating purposes. If you end up not paying any fee to him, obviously your command over the phone is considered as a contract, and you will obviously be sued in a court of law that you have given instructions orally which have made you binding to comply with this particular position kind of stuff. Next, what do you mean by implied contract? Implied contract predominantly means there is no agreement that I would, okay, best example is generally in some of the apparel industry or shops where you will be seeing goods once sold will not be accepted for return. Maybe out of loyalty gesture, because of his good name, he might choose to take returns from the customers over a period of time. So although contractually he has told you that I will not accept any returns, he has been doing a particular activity which creates a valid expectation in the mind of the recipient that he would adhere to this particular activity. So that creates a constructive obligation and that becomes an implied contract. In fact, IAS 19, Ind As 19 and Ind As 37 use the word constructive obligation. After these two accounting standards, it was Ind As 115 that particularly used constructive obligation to say any activity that has been done by the entity, even though not contractually promised to customer, and if the customer expects that as part of the business that he would be doing or he would be offering this kind of a service to me, definitely that would become a performance obligation here. So a contract can be written, a contract can be oral, a contract can be implied. Next, having said that, we have some agreed, coming back to our example, we have agreed certain terms with our customer, which was written, and now the accounting standard gives us guidance as to what will be my fundamental attributes to say that whether it is a contract or not. See, why does an accounting standard has to prescribe that there has to be a contract with customer? It defines the framework between the parties. When you are playing a game, you have to play by the rules. So I should first of all know what my rights are, what my obligations are, what all I should do in order to receive A, B, C, D, E. So the fundamental attribute of our contract is the terms that you have entered into with the customer has to be agreed by both the parties. Consensus ad idem under our contract act. Okay, both the parties know what they want to do and both the parties are committed to performing this particular stuff. Second, both the parties know their rights and obligations. Third one, the payment terms have been defined. Nothing is charity in business. I am doing this stuff for so and so particular consideration. When would I get the consideration? It's not about amount that you would receive. It is about when you would receive that amount, because that is the most important thing to say. I have understood some of the terms with the customer. When you are rendering the service, obviously as an employee, we all know that we are more interested in, after knowing the amount of salary, we are more interested in knowing when the salary would get credited. It's more or less the same kind of stuff. The payment terms are known. The contract has commercial substance. As I said, sometimes not all the transactions will have commercial substance. For that, accounting standard gives us some guidance. Just to give you an example, sometimes the transactions with related parties or transactions may or may not have that element of commercial substance. The same language has been used even under Ind As 16 and Ind As 38 when they are explaining exchange of assets between the parties for non-cash consideration. If the exchange lacks commercial substance, no accounting is done. Similarly, if the transaction between the customer and the entity lacks commercial substance, it means as if there is no contract with the customer. That means step 1 itself has failed. So now you need not go to 2, 3, 4, and 5. There is no concept of recognition of revenue. Change the terms, bring some commercial substance. What do you mean by bringing commercial substance? The configuration of cash flows, the risk, timing, and amount of cash flows before the transaction and after the transaction should change. So if you're exactly doing the transaction at cost, that's the reason why common control transactions are always recorded. In case of a business combination, you must have seen Appendix C. Common control transactions are recorded at the carrying cost of the seller. To an extent, mainly because the common control transactions lack commercial substance kind of stuff. That's the reason why when it is changing the hands, it's recorded at carrying cost kind of stuff. Fifth one, slightly intriguing, looks out of place, but still that particular point is considered as the most important point in determining whether you have a contract with customer or not. Very, very interesting. If your customer, if you, based on your experience, if you believe that you will not be able to collect whatever the money that the customer promised that he would pay to me, it is as good as you don't have a contract with customer. Frankly speaking, a legally binding agreement specifying so much amount of consideration, requiring us to have a separate evaluation that please evaluate whether that guy would still be able to pay or not, means ability and intent of the customer to pay the money on the due date. If you say that you don't have that probability, it is as good as you don't have the contract with customer. What sort of a contract can it be? I'll just give you one small example. Say, for example, I am in the business of real estate, where I want to give one of my buildings for rent or whatever that purpose to other party, and there is a consideration that has been given. Say, for example, in this example, it was 12,50,000 rupees. But I know the customer to whom I am giving my building on rent or lease or whatever, is a guy who does not have any experience in hotel industry, and he wants to start off a hotel at this point in time. Knowing the economic compulsions outside, decline in the demand outside, and lack of experience, I don't believe that he would pay 12,50,000 per annum to me in the form of rental. When I believe that he does not have the ability to pay 12,50,000, I need to have an evaluation. What is the value at which he would be able to pay me? Say, for example, if it is only 6 lakhs, then your contract amount is 6 lakhs and your recognition is only towards 6 lakhs. How it will be recognized is not explained here. Objective is not to discuss in this slide how and at what point in time it will be recognized. It is only to say, I need to say whether I have a contract or not. If you believe that, okay, boss, I don't know unless and until I receive 3 or 4 months of money from him, I don't know whether I will be able to get any money from him. For next 3 or 4 months, it is as good as you don't have any contract with him. It comes only when once you have that evaluation that it is probable that I would receive the money. Now in this, there is one practical expedient. Generally, standard expects that this probability assessment will not be a hindrance for you, because generally entities would enter into known customers only, or there must be some credible history, unless you are pretty new to business or the person with whom you are entering into business is pretty new. That's okay, then you will have the teething trouble. What happens to portfolio of receivables? That means, say for example, you are dealing with, your client base is predominantly either in India or in some developing economy or some emerging markets like Russia and other CISR markets. Okay, you know that definitely there will be one or two customers who would default, but you can't pinpoint who would, whether it is A, B, or X, Y, or Z. So you don't know which customer would default, but definitely 3 or 4 customers would default. So history suggests that you know that 5% of your sales will not come back. Then what should you do? Should you not recognize the revenue? Accounting standard gives you a practical expedient. Whenever you have that kind of a portfolio position, don't come to a harsh conclusion that there is no contract with the customer and accordingly step 1 has failed. Consider that as allowance for credit losses under expected credit loss model under Ind As 109. So it does not hit you from Ind As 115 point of view, it hits you from Ind As 109 point of view. Maybe you need to see what will be my day 1 credit loss possible and make that portion as a allowance for credit loss. Okay, when you should reassess this kind of a collectability if you have an issue, you need, it's not that, okay, every day, tomorrow, is there a probability? Day after tomorrow, will there be a probability? No, you will not be able to do it at reasonable interval. Say if you have a quarterly reporting at every point in time, because you need to prepare a balance sheet, at every balance sheet date, make sure that whether this particular position or assessment holds good or not, or is there any betterment in the credit worthiness of my customer so that my analysis changes. Okay. Now, the concept of combining the contracts. Now we have dealt with, continuing our example, that we entered into a contract with our customer. Similarly, I have entered into many contracts with the same customer. All these 3 contracts, should I be considering it as one and the same, or should I be separating these contracts, or should I be combining the contracts? Obviously, to separate, just because the pieces of paper are different or they have been entered on a different dates, that does not mean these are separate contracts. You might need to combine the contracts if the contracts have been entered into in the following manner. That means if any one or more of the following criteria fulfill, then you need to combine the contracts. What are those? If all the contracts have been entered into for the purpose of same commercial objective. Second, the consideration for one contract depends on consideration for another contract. Third, all the performance obligations represent a single performance obligation. That means whatever that I am planning to purchase is a single performance obligation. Try to keep the third point on hold. You will get to understand when once you understand the second position. Let me give you a small example to make you understand this. Say for example, Indian government placed an order for 30 fighter jets with Boeing. After that, it entered into another contract for another 15 jets, which are fighter jets, and 15 commercial flights with Boeing. Now, at that point in time, you need to see whether the contract entered by the Indian government for the second time for 15 fighter jets and 15 commercial flights. Is it something that needs to be combined with first contract, or should it be dealt with second contract? First and foremost, identify whether both the contracts are at their respective standalone selling prices or not. That means the second contract of 15 fighter jets and 15 commercial flights has its own value, which is more or less in sync with the first contract. Good, both are separate. At the same point in time, one more pointer for you. Was in the second contract, only 15, half of the contract is for the same methodology or same purpose for which the first contract is made, which is fighter jets. The second is obviously for commercial flights. The commercial economics does not match here. So obviously these two are two separate contracts. Yes, one argument. Second, third one, the goods and services promised are a single performance obligation. May or may not be, because when once my standalone selling price is different, obviously these two will be different. It's not that I can't raise more than one contract with that guy. First and foremost important point is, see what is the price at which that particular second contract has been placed. Is it at its standalone selling price? If it is not at its standalone selling price, please try to combine it. Then try to see, boss, is it made more or less at the same point in time, or more or less at with the same commercial objective or not, kind of stuff. Fine, this has little more depth to it than what has been explained in just 1 or 2 minutes now. I'll just pass on to some other slides as such. So just let me give you with one small example. Software company S enters into a contract to license its customer relationship management with customer B. 3 months later, in a separate contract, S agrees to provide consultancy services that require significantly customized licensed software. That means I am not only giving you a customer a license, a software license for you to work. After 3 months, I entered into an agreement to implement that particular thing. So to say, forget about that example. I bought S4 HANA from SAP, and after 3 months, I entered into another agreement with SAP for implementing S4 HANA in my entity. What will he implement without having the license?
Sir, there is someone saying like slides are not moving. We tried. It is stuck that identify the contract with the customer.
Is it combining of contracts? Is that the example that is being visible to you?
No, sir. Identify the contract with the customer is the headline. Entity must first identify the
contract. Then let me share the presentation once again. Is it visible now?
Yes, sir. Same page.
No. Heading is identify the contract with customer, but is it on combining of contracts?
Yes, sir. Yes, sir.
Yeah. Now let's. Sorry, I can't actually see who is raising the hand and who is raising the query. So I will have to. You have to pardon me for that. Okay. Say for example, coming back to our example, we entered into a contract with SAP for purchase of S4 HANA license, and after 3 months, I entered into another contract with SAP for implementation that requires significant customization of that S4 HANA into my organization when at the time of implementing, because I have my own customization models and whatever that I want to go for consolidation model and all that stuff. Now, these two technically are so integrally intertwined with each other. Obviously, my customization cannot happen without the license. It's not about whether another party can do it or not. Because I entered into an agreement with the same SAP and the same party, should these two contracts be, first of all, looked alike or not, or should these two contracts be combined or not? In the given example, the answer is yes. Because it is obviously without one, another is not possible. I can't implement without the license. And I can't just like that license, which requires significant amount of customization. So obviously in this case, the contracts have to be combined and has to be seen as a single contract. Now a practical question that might come is, what is the time period that needs to be considered by the entity? Is it 3 months, 6 months, 3 days, 30 days? What is it? There is no limit. It is dependent on the judgment. A very harsh example which I am taking, I read one of the revenue recognition guides written by US GAAP standard setter. Maybe you can check it in Google. His name is Scott Taub. The guide is called Revenue Recognition Guide. He goes to an extreme position of saying even a contract entered into in a year's term might need to be seen from a combining of contracts point of view. Too harsh an example, too hypothetical a position also, but don't get into that kind of a zone. Be little vigilant and then see, okay, boss, are there any contracts that you are that are being entered by the entity more or less in a month or 2 months or 3 months kind of a stuff? Indeed, there is a possibility for you to look up into this contract. Now, moving on, contract modifications, practically known as variation orders or modification orders. Now you have one contract with one party, then you have another contract with the party, both you have combined. Now with the same party, you have entered for a variation in the work order after some point in time. What should be the accounting consideration whenever there are any modifications? Frankly speaking, in terms of content, this particular topic will take some decent amount of time. Given the paucity, I'm just limiting myself only with the guidance that is needed at an overall level. Okay. Whenever there is any modification, you need to first see whether the modification results in a new contract. The accounting standard gives us the following guidance. Either the modification can become a new contract, or it can become only modification of the existing contract as such. Just to give you a small example, say for I have entered into a contract with a customer to supply 1,000 pens. Later on, I have changed my contract. Please, supply me even 150 dusters as well. Okay, not just the markers, but also the dusters. Now, is this modification, will this result in new contract, or is it only an updation of the existing contract? Depends on the modification it will happen, and let's take one by one. Let's try to understand. When a particular modification is considered as a new contract altogether, in only one case where the following two conditions have to be satisfied. Whatever you have asked for is a distinct good, and whatever that you have, the price at which that has been decided is at its standalone selling price. So I initially have entered into a contract for supply of pens. Later on, I have entered into a contract for supply of dusters. Distinct does not mean pens and dusters. Pardon me for a very crude and layman example. I will correct this example little later after the steps. But for the time being, to understand in a very layman way of pens versus dusters. Now, duster is a distinct item from pen, and it has its own standalone selling price. So my contract of supply of dusters is a separate contract. So I need not bother about the original contract. When these two conditions satisfy, it is altogether a new contract. And under what circumstances it is an existence of existing contract itself. So now in any other scenario, you need to presume one thing, that the standalone selling price, that the pricing of the modified contract is not at the standalone selling price. At that point in time, if we have an additional modification of the contract, it might result in termination of an existing contract, or it might result in updation of a cumulative catch-up of the existing contract, or it might result in both. With one small example, I'll just pause this particular concept. Take for this particular point of view, this particular example, say an entity promises to sell 120 products for a value of 12,000. So it is 100 per product. The products are transferred to the customer over a 6 months period. The entity transfers control of each product at a point in time. After the entity has transferred control of 60 products to the customer, the contract is modified to require the delivery of additional 30 products. That means after finishing the contract, original contract by half, I got an additional 30. Now, how many I need to supply now? After 60 plus 30, 90 I need to supply. The additional 30 products were not included in the initial contract. That's the reason why modification has come into picture. Now he is giving us case 1. When the contract is modified, the price of the contract for the additional 30 products is at 95. The original contract was at 900. The second contract was at 95. So technically 100 and 95, in this example, it presumes that it is at a standalone selling price. So you need not do anything. As and when you sell the 61st product, you need to recognize revenue with 100 only. don't get bothered by the modified contract which requires supply at 95 for the additional 30. So here the fundamental question is, after 60, when I sell the additional product, one product to him, what is the price at which I should recognize the revenue? Is it 100 or 95 or is blended rate? He is saying because the second contract is at its standalone selling price. Maybe that is the discount he offers, that 5% discount he offers because whenever there is a bulk order. So when 95 gets established as the standalone selling price, please, as and when you sell the product after 60 till 120, you please recognize the revenue at 100. And once you enter the 30 contract, recognize the revenue at 95. That means there is no overlap between these numbers. On the other hand, let's go with this example. Now the scenario changes. During the process of negotiation, the purchase of an additional 30 products, the parties initially agree that a price of 80 per product. Now, continuing the example, if 95 is the standalone value, definitely there is a commercial sense for us to say that 80 is not the standalone selling price. So the additional 30 is not at standalone selling price. Now, move forward. However, the customer discovers that initial 60 products transferred to customer had some minor defects, and those defects are unique to the delivered products. The entity promises a partial credit of 15 per unit to compensate the customer for the poor quality of those products. Accordingly, the customer agreed to incorporate a credit of 900, 15 into 60 products, because 900 is the value that I have to give credit to him. And because of that 900, I am compensating for whatever that, this gets adjusted in the value of 80 that has to be obtained from him. So what he says is into the price that the entity charges for that additional 30 products. Consequently, the contract modification specifies that the price of the additional 30 products is 1500 or 50 per unit. So they first started with 80, and because 90 is something that has to be adjusted, they finally came back to 50. Now, how should this particular transaction be dealt with? Separate these two. Whatever the credit that you are offering is a consideration that goes back to customer, and hence it has to be adjusted as a reduction from revenue. So although it is considered as an adjustment price for the next supply of 30, separate it first. Now take it back to 80. So take that 15 into 60, 900 as a reduction from revenue which you have previously recognized. Meaning 60 products into 100, 6,000 or something he must have recognized. First reduce the revenue from that, reduce this particular amount from that revenue. After that, you have to deal with, because it is not at the standalone value, have a cumulative impact of the whole transaction. So you need to have 100 into 60 products which are not yet transferred, and 80 into 30 products yet to be transferred divided by 90. So 80 into 30, 100 into 60 divided by 90 products. So the entire modified contract value is 93.33. Now you need to consider whenever one unit is sold, even though he gives you 100 as per the old contract, you need to recognize revenue of 93.33 and put at either deferred revenue or advance concept of 6.67. So when a modification of a contract results in termination, when it results in updation of the existing contract, when it is combination of both, is predominantly guided by these principles. That whether it is distinct or not, or whether the price offered for the modified contract is at its standalone price or not. Okay, now till that point in time, what happens for any money that has been received by the customer? Very, very important. Here I want to make some specific pointers here. So the contract with customer, that step was not met, by which time you have received some non-refundable upfront consideration from your customer. I repeat, you have received non-refundable upfront consideration from your customer, and as per your contract, it is specifically did not meet that step 1 parameter. Whatever the money that received from him is non-refundable. At what point, then what should I do? Just because it is non-refundable, should I recognize the revenue? I'll explain the whole position with one small example, which I have picked up from one of the advertisements which I have seen in the TV. You must have seen Bonwell chocolate ad, that previous ad, I mean, in a few years back. At the end of that particular advertisement, the following lines appear. It is not a chocolate that is just bought, it is a chocolate that has to be earned by you. Revenue recognition is a principle of earning of revenue. Non-refundability does not mean anything from revenue recognition point of view. Signing the agreement and receiving upfront consideration does not mean you have performed anything. You haven't earned that particular amount of money. So even though there is an upfront consideration, non-refundable in nature, I repeat, I know that some of you must have gotten shocks. Non-refundability does not mean anything from revenue point of view. Even though it is upfront, it has been received, you need to assess it. What are the other performance obligations? Did I perform that obligation or not? If you haven't performed any of the obligations, it goes in the form of a liability. It sits as an advance in your books till the time the other obligations are performed. So to give you an example from very relevant industry from which I have come from, pharmaceutical industry, you have transferred a license to your customer. That means you sold a product and asked him that, okay, and you will also promise that you will supply some of the product to him. For selling the license, you have taken an upfront non-refundable amount of some $1 million. But that piece of paper does not mean anything to him unless he receives the product from you. So even though the amount is non-refundable, because it does not have any standalone value to customer, this particular amount sits in your books of account as a deferred revenue or as an advance for that matter, which gets carved out to profit and loss account at a regular intervals. Now, coming back to the second point, identify the performance obligation. Yeah, they are significantly back in terms of our time schedule, but that's okay. Let me, see how to what extent I would be able to. Now, don't focus too much on the slides that I'm going to present. Focus on basically whatever the point that I'm trying to make out here. So, what do you mean by identify the performance obligations here? So, continuing with whatever the example that we have, you have a contract with customer and the contract specified some A, B, C, D, E promises. Follow my language very carefully. The contract with your customer specified some promises. You need to do this, you need to do that, you will get X amount of money. Accounting wise, from accounting standards point of view, all the promises are not performance obligations. You might have n number of promises, but all those promises do not become performance obligations. Like how? All the agreements are not contracts, but all the contracts are agreements. All the economic promises in your contract are not accounting performance obligations. Then what kind of a promise becomes performance obligation? If it becomes distinct, if it meets certain characteristic features of being distinct, then it is called basically a performance obligation. What do you mean by a performance obligation becoming distinct performance obligation? Very simple criteria. Always remember one thing, this accounting standard was written from a customer's point of view, not from vendor's point of view. It is a customer-centric accounting standard. Whether there is a standalone value for the delivered component and for the balance undelivered components, will there be anybody in the market who can supply me the product? A classic age-old example which I have been taking in all these classes, I'll repeat here. Take the case of an Axe deodorant. You know, how does he supply the product? First he supplies the nozzle, then he supplies the bottle. In the third consignment comes so-called the gas or liquid or whatever it is, or semi-gaseous state or whatever it is. So what is more important for the consumer? It is not the nozzle or it is the bottle. It is the content that is more important to the consumer. And Acts recognizes revenue only after the third consignment is sold, not when 1 and 2 is sold. Because whatever 1 and 2 are sold, they don't have any standalone value to customer. I repeat, if at all you want to decide what my promise is and whether my promise has any value to customer or not, see it from that angle. With the delivered component and with the balance of the promises, can he obtain from a third market participant, and can he continue the business? Taking an example of say pharmaceutical industry, I sold the license as well as I entered into a supply of the product. Obviously, without supply of the product, not in all circumstances you will be able to prove basically a standalone value. Then it becomes a combined contract. You know, a significant complex machinery that has been transferred, and where erection can be done only, or installation can be done only by the supplier. Obviously, it becomes a single contract. Very easier contract to understand. Automobile industry, I am selling the product and I am also selling you the maintenance contract. You need not buy it, although it comes as part of the contract, because there are many other participants who can give me maintenance services for the vehicle that I have procured from you. That's the reason why in automobile industry, obviously the whole contract is a 2 performance obligation contract. As and when the vehicle is sold, you will recognize something. As and when the maintenance services are rendered, you will recognize the balance amount. So it is more of a customer-centric point of view. Second criterion, whether in the context of the contract, whether it is basically a distinct performance obligation or not. What do you mean by distinct within the context of the contract? Accounting standard Ind As 115 has specified that under 3 circumstances, even though there are market players who can provide you that kind of a service, it is predominantly considered as ruled out from the point of view of separability criteria. So it is considered as a single contract. What are those 3 scenarios? That means these are specific scenarios identified in the accounting standard. Significant element of integration, wherever the contract has required significant element of integration. Sometimes this is exclusively applicable or to an extent predominantly written from the point of view of real estate and infrastructure industry. Say for example, the objective of the party customer is to get a hospital built, for which he can enter into n number of contracts with the real estate builder. Whatever that foundation for one contract, and building of the hospital one contract, procurement of all the equipment in one contract, and maintenance services in one particular contract. Although each and every piece can be sold or can be obtained from the party outside, generally all these activities are significantly integrated with one another. Why am I saying integrated? Obviously, in order to run it as a hospital, you need basically significant integration services. That's the reason why the whole contract is considered as a single contract. So whenever there is any significant integration activity that needs to be done, you need to predominantly consider it as a single contract. Second, when there is a significant customization needed, same example you can consider S/4HANA, and the basic software is not generally useful for the customers unless it is significantly customized. Hypothetically, I am giving you a position. Let's assume S/4HANA has to be significantly customized. Your customization contract and the main contract cannot be considered as one and the same if you have entered into with only one party. You can choose to say that I want to buy license from SAP, and Accenture or IBM will implement the license in my books of in my entity. Then it is a separate case. And I'm saying when it is entered with a single party. And third one, highly dependent and highly related. Say for example, taking the case of pharmaceutical industry, the same age-old example, I have sold the license and I have entered into a contract to supply the product. What will the customer do with only the right that has been transferred to him unless I have the product to sell? They are highly dependent and highly related to each other. So obviously, these under these 3 circumstances, even though they are distinct performance obligations, they have to be seen as a single performance obligation. This is the example which I was talking about, construction of a hospital where significant integration services are needed. There is one particular blue colored statement which I have mentioned, a copyright at the rate of IFRS Foundation. It is a dictum from IASB that any person who is using example verbatim from the main accounting standard. I don't know how many examples are there in the Institute's educational material on revenue, but when the standard was released by IASB, it is accompanied by 63 official examples. So 129 paragraphs and 63 examples, keeping aside the appendices from A to E. Those 63 examples, I have picked up a few examples verbatim. When I have picked up those examples verbatim, I need to use the word, it is the property of IFRS. That's the reason why you will find this. That's the reason why even I have not changed some of the language mentioned in that particular accounting example. Okay, now going back to this particular position, we have seen significant integration service, then customization as for HANA license and customization. Highly interrelated and highly dependent. It is sale of goods and sale of dossier and supply of the product. Okay, next. Apart from that, so you have identified 10 promises. Based on those 10 promises, you have analyzed those 10 promises from performance obligations point of view, and your contract has, say for example, 5 performance obligations. Now going, I'm skipping for the time being the series example. If there is time, I will just explain it at the end. Otherwise, I'm just moving forward. Coming back to our original example, I have entered into a piece of contract with my customer, and the contract has been combined with other contract that has been entered or modified at a later point in time. These two contracts have 10 promises, and those 10 promises became 5 performance obligations. Meaning, if the promise does not become performance obligation, keep adding one after the other and see whether 2 promises become a distinct performance obligation or not, or 3 promises become a distinct performance obligation or not. So continuing our example, our 10 promises have become 5 performance obligations. Okay, now in this particular step, the accounting standard brings some of the practical positions that have to be dealt with, which are nothing but principal versus agent considerations. Going back to the same example, make my trip, where in some of the circumstances he offers as a principal obligor space in a particular hotel to a traveler, and in another circumstance where he offers merely as a platform provider on behalf of the hotel. So principal versus agent consideration is, whenever in a contract there is a third party along with the customer and the vendor, and there is a third party who is a service provider that is also there, you need to assess what the entity's position is. Am I a principal, or am I only an agent who is doing this particular transaction? What are the characteristic features, or what are the fundamental attributes of a principal? Principal becomes the primary obligor who takes the responsibility of providing the service. Take the case of urban company or urban club. Very, very crude example of, you have opted for a service of crop, hair crop. You will not be able to decide initially. The manner in which it is decided is, the service provider will be assigned to you 1 hour before the date or time of the service. So the primary obligor here is urban club. He has to provide me the service. What is the price at which it is being offered? It is urban club that is offering me the amount. The barber who comes to my home does not have a say in terms of determining what is the value. Same is the case with a sophisticated example. Uber or Ola, you don't select the cab driver. It is Uber who takes the responsibility of providing you a cab, primary obligor. Who has a latitude in determining the prices? Who decides the price of that particular transportation? It is Uber. Who takes the price risk? That means if something happens that, for that particular transportation, everything is taken care by the Uber. So who is the primary obligor? Who takes the inventory risk? Who takes the price risk? And who has the discretion or latitude in determining the prices? It is that guy who is principal. Now put this example for any crude example of Urban Clap or MedPlus, Practo. I have decided, say for example, in case of Practo, you wanted a consultation of a particular doctor. Now, Practo does not define you to which doctor I should go. You have decided, boss, I want to go and see this particular doctor. Then Practo is only a platform provider. He is not the primary obligor. He is not assigning you any doctor that whom you want to see. You want to attend a particular doctor. So it differs from contract to contract. I'm not saying that for each and every contract or in a particular business case, a particular, a guy will continue to be a principal and a guy continues to be an agent. It is not the case. You can read Make My Trip's annual report. In Make My Trip annual report, he says that in majority of the contract, I'm only an agent, and in certain circumstances, I turn out to be a principal, where I buy space from the hotel directly and I sell it to the customer. So whenever there is a third party involved, always assess who is the principal and who is the agent. Agent recognizes only the commission as revenue. Principal recognizes, on the other hand, the entire amount of money that he collects from the customer as revenue. These are the pointers, in fact. The base position is anybody, whoever is interested, read EATF 9919 under US GAAP, which clearly explains what are the principal versus agent consideration. Fine, only for the knowledge sake I'm sharing with you. It's up to you whether you want to go through that content or not. These are some of the examples. Consignment, no, I mean, it's no brainer. Generally, consignment transactions are not revenue transactions unless until the consignee sells the product to an outside customer. Even though he is a Del Credere Commission who takes the responsibility of collecting, that's all together, absolutely. Because with respect to consignment, the complete control stays with the consignor himself. He decides what sort of price that he has to sell it, at what at what time you have to sell it, and all the conditions relating to it. All these have been considered to be the control is still with the consignor, and that's the reason why in consignment transaction you won't recognize anything. Customer options for additional goods and services, typically referred to as customer loyalty programs. Say for example, you visited Central, Hyderabad Central or whatever it is, you bought some product for 10,000 rupees and you were given a voucher which has 1,000 rupees credit. There is a deadline to it, say by August 31st, if you purchase another 5,000 rupees, you will get a credit of 1,000. Now, how should this voucher be recognized in the books of account? It's a very, very crude example of explaining customer loyalty programs, the basic example, and I'm explaining with that kind of thing, given the time frame we have. So once you sell the revenue of 10,000, is it entire amount of 10,000 or should I consider this as a discount? What accounting standard says is it cannot be considered as a discount because it is not offered to all the customers. Only those customers who have purchased beyond a particular level value, those have been given this particular discount coupon. So it is a material right available to only a select few, and hence it has to be considered as a separate performance obligation. Let's assume you are a vivid shopaholic basically, and you will definitely redeem this particular voucher. So the accounting is bank account debit 10,000, revenue account debit 9,000 only, and deferred revenue of 1,000, which is the fair value of the voucher that has been given by Central. Then once you purchase the 5,000 on August 30th, you will use this and pay him only 4,000, right? So bank account debit 4,000, deferred revenue which was previously credited of 1,000 in the first entry becomes debit of 1,000 to revenue of 5,000. Net 10,000 plus 5,000, 15,000 is revenue. You have given him 1,000 discount and you have received basically initially 10,000 and later on 4,000, 14,000. Sorry, 9,000 and 5,000 revenue is 14,000 only. 14,000 you have received, 14,000 is the revenue number, but not recognized as 10 and 5, but rather recognized as 9 and 5 kind of. 10 and 4, but rather recognized as 9 and 5. That's the only catch here. I have given one example here where it is not just one customer, but rather more than one customers, and what is that material right component that has been separately identified. You can go through the example and you can basically make out. Now, very, very important point, sale of product with a right of return, allowance for sales returns. There was no clear guidance before, there is a guidance now. Here it only talks about allowance for sale return as a separate performance obligation or as a reduction of revenue. But because the topic has come, I am explaining the whole transaction right now and the accounting for allowance for sales returns. Say for example, you have sold 100 units to various customers, and historically you believe that 3% is the normal return that will come to you. Now this accounting standard explicitly specifies that 3% of your revenue number cannot be recognized as revenue right now, but rather it has to be recognized as a refund liability, because historical position suggested that 3% of the consideration that is received today would go back to you, go back to customer. So even though you have received 100 rupees for 100 units sold, your revenue would, your transaction, your entry would be bank account debit 100 to revenue 97 to refund liability 3. Second, what should I do? Now he goes little forward and thinks about your right to obtain the product when that guy has a right to return the product. Little intriguing statement, whatever I have made. It is called in accounting language a contract asset, meaning whatever the likely returns that you can get back, if they are repairable and saleable, only based on your industry practice, if you believe that these are repairable and are saleable returns that will come to you, you have to reverse the COGS also. So now recognize a contract asset with a corresponding credit to COGS number. So now allowance for sales returns has clearly 2 entries that are to be posted by the entity. Bank account debit to revenue account 97 to refund liability. I am not using the word allowance for sales returns and all that. The jargon is to refund liability 93, and if it is a saleable and repairable return and it can be sold at a profit, then recognize the profit. Then recognize the asset. If it is not repairable, not saleable, like in the case of pharma, a pharmaceutical product generally returned, only in case of certain API, you might recognize that contract asset. Otherwise, in a case of normal, consumable product by the patient, it is not something a contract asset that can be created. When once a return comes, either it is incinerated or it is generally destroyed. So you won't create any contract asset. Sorry. So the condition for creating the contract asset is your ability to resell the product beyond the value of the cost. If it is lower than the value of the cost, or it is something which you cannot decipher right now, don't recognize the entry. Okay. Contract asset, where it should be disclosed in the books of account. Not very clear from the accounting standard. You can include it as part of inventory, or you can include it as part of other assets. Entire Big Four is also divided. Whichever may be the line item, you include this particular contract asset, disclose it specifically in your notes of account that what is the line item in which this contract asset is included. So I'm moving on with this. Now determine the transaction price. So you have the contract with your customer. There are 10 promises. they became 5 performance obligations. You have identified what is the likely return and you have made some provision for it. Now you have in your contract, the transaction price needs to be first determined. When you looked at the contract price as per your terms, there is one single number. There is no number for each and every promise that has been made or each and every performance obligation that has been identified by you. So whenever there is, even though it is separate, your objective is to determine the transaction price as per the agreement. What do you mean by this transaction price? It is not the list price or it is not the contract price as per the agreement. It is a derivative from your accounting position. What does transaction price mean? It means whatever the money that you initially believe that it is probable to be collected, plus or minus any variable consideration. So fixed consideration plus or minus variable consideration. What do you mean by plus or minus variable consideration? You might offer growth rebates to customers, that if the customer picks beyond the specified levels, I will offer you some discount. That becomes basically a variable consideration. So you need to determine what portion of consideration is more likely that it would go back. It can be plus. It can be a scenario of profit share. I am selling you at 100. If you sell the product at 110 or 120, we will share from that extra 20 rupees whatever you have sold, either in a particular ratio. So it's not just that 100 I will get, but I can get extra. What if it is a loss share? If I could sell only at 90, I will take up the cost also. So any possibility of my basic floor price getting changed either by way of profit share or by way of discount, plus or minus, needs to be accounted for on day one itself. When does variable consideration come into your books of account? Preamble kind of a statement, when you believe that it is highly probable that amount would be realized by an entity, or highly probable that this discount would be paid by an entity. Now, what do you mean by highly probable? Accounting standard did not define the word highly probable. Probable word is defined under Ind As 37 as more likely than not. So if somebody were to put a number, they can say that it is greater than 50%. Now, what is highly probable? Is it 60%, 70%, 80%? Judgmental. Little difficult if it is less than 80% or 85% kind of a stuff. Different big fours, although they did not document anywhere else, practically they have their own limits to say that whatever that particular position has to be done. At the end of the day, trust me, this does not go by percentage. This more goes by the way you would be able to demonstrate whether you will be able to get revenue or not. Say, just to give you profit share kind of a business based on your past sales, what is the average selling price that you will be able to sell? Maybe you can pick it up. In a very difficult scenario like pharmaceutical industry, where some consideration will come to you after the product gets approved by US FDA, extremely difficult. You can't decipher or you can't decide when the product would receive US FDA approval. So that predominantly is the position when it comes to determining the transaction price. It is not the list price, or it is not the contract price. It is plus or minus the variable consideration. Now, what is the when I should recognize the variable consideration? It is the moment it is highly probable. So I'll pick one example for you, then probably you will be able to understand. Say, take the example, whatever that table is there. Entity A provides transportation services to theme park customers for a fixed fee of 400,000. So consideration has a fixed component of 400,000 and it has a bonus that ranges from 0 to 600,000. Now, how should an entity consider whether bonus should be included on day one or not if that has a history of the following probabilities? For 0 bonus, there is 30% chance. For 200,000 bonus, 30% chance. Meaning, okay, for 400,000, so there are certain percentages given. Now, what is the methodology that can be used in determining the bonus? Refer to whatever that was there under Ind As 37. How a provision amount is measured, expected outcome approach or most likely outcome approach. Same principles have been used even under Ind As 115. What is the expected amount of bonus? 200,000 into 30, 60,000. 400,000 into 35, 1,40,000. 600,000 into 5, 30,000. Add 2,30,000 is the expected outcome approach based bonus. So what is the value that I should recognize? 400,000 plus 230,000 on day one. Is there any other possibility? Look at what is there in the box here. Would the answer be different if the bonus amount can only be one amount but not a range? See, 230 falls between 200,000 and 400,000. So let's assume the contract says either I will give you a bonus of 200, or I will give you a bonus of 400, or I will give you a bonus of 600, but not intermediate numbers. Then what is the value that I should recognize? Read it in an inverse way. You will better be able to comprehend. I have 5% chance of receiving 600,000 bonus. I have 40% chance of recognizing 400,000. I think I need not explain why the probability gets added. I have 70% chance that I would get 200,000 bonus, right? So you have higher probability of 200,000. So if it were to be only one number, I would recognize a bonus of 200,000. If it were to be any number within a range of 0 to 600,000, I would recognize 230,000. Depending on the type of provision incorporated in your contract, you will end up deciding what will be the transaction price. Now, in this particular section where the right of return, that allowance for sales returns would be explained in detail. Whatever that I have explained, that revenue will be recognized and a refund liability will be recognized, and asset will be created only when once the supplier can establish that the return from the customer is saleable and repairable. I'm pausing this. Significant financing component, Deepak ji, do I have any 10-15 minutes extra?
Sure, sir, not an issue. Please proceed.
Fine. Yeah. Then I will try to put it up till 8:15 kind of stuff, because unnecessarily I don't want to rush through when there is some content that needs to be explained. Yeah. Coming to significant financing component, that means whenever your transaction has a significant financing component, you need to eliminate the financing element of it. It will be very easier for a financial services based person to say that whether there is a significant financing element or not in his particular contract. Generally the examples would be more for those kind of businesses, very less for a normal trader kind of stuff. Say for example, for a HDFC bank, a housing loan definitely has a significant financing element. So you need to definitely remove the interest component and recognize what is towards housing loan as a normal revenue and what is towards interest as an Ind As 109 interest component using IRR model. Let's take keeping that financial services example aside, let's understand under what circumstances that can arise for a normal business guy. So if you have an extended credit term here means, generally I want to make it little more clear. See, if you have a customer who has 90 days credit period, another customer who has 120 days credit period, another customer who has 180, that does not mean 120 and 180 have extended credit periods. Depending on the credit worthiness, you can choose whatever that guy is capable of in terms of determining the credit period. Is it comparable with competitors? Let's say, for example, your average credit period that is being given to customer is 150, but your competitor is giving 120. Does that mean 30 is extended credit period? No. It is not with respect to other customers. It is not in comparison with other companies. Assuming today you have a customer A who has 90 days credit period, and in the next year, for nothing, you have extended the credit period for one particular consignment. There is no change in the credit worthiness of the customer. For one particular consignment, you have made it 175 days, and for rest of the consignment, it is 90. Then there is an element of doubt that can come in your mind that whether this 175 for one consignment versus 90 for another consignment. To put it very crudely and very directly, whenever you are launching the product, to pick the stocks on day one, generally entities would resort to extended credit terms in some of the geographies. There you need to go for element of financing. If you have ruled out that the customer will have no problem in paying the full consideration for the lump sum stock he picked up, where step 1 has already been crossed by you, please see for that 175 minus 90, 85 days, please take out the financing element from it. At what rate you need to take out? Assuming the similar value for a 6 months or 85 days means max to max 3 months. A 3-month loan for so much amount of sale value, what is the borrowing rate that is needed in that particular geography? Use that rate, remove that financing component from it, recognize the transaction at cash price, recognize the interest at a regular interest. That means not the entire money that comes from your customer is revenue. A portion goes as an interest income and a portion goes, balance component only goes as a revenue. Non-cash consideration, we anyways have Ind As 113, it needs to be fair valued, but if it is anything to do with, share-based payment kind of stuff, maybe you need to evaluate using Ind As 102 kind of a scenario. Very important point, very, very important point. Consideration payable or paid to customer. What do you mean by this? That means whatever may be the scenario, whatever may be the contractual provision, it can be by way of allowance for sales returns, or it can be by way of discounts, rebates, or it can be any other failure to supply, that I am paying some consideration back to the customer. When the customer sells and it returns the product to you, you have to pay the consideration back. When you offer some growth rebate to him, you need to pay some consideration back to the customer. When you have the inability to supply the product, no sales, failure to supply, and a contractual provision kicks in and you have to pay some money to the customer back. Whatever may be the scenario, I've just taken 3 example scenarios. If there is a practical position that you have to pay some consideration back to your customer, is it an expense or is it a reduction from revenue? The standard first starts with a position that it is a reduction from revenue. It can be an expense only and only if both the following 2 conditions are satisfied. What are those 2 conditions? If it is for a different service not related to the sale contract. I'll give you an example to understand. And the value of that contract is at fair value. That means the transaction has been executed at fair value. Very, very age-old example which I use for all my classes. I am repeating the same example. When I was doing the audit in KPMG, that's the kind of an example that I have understood. KPMG was the auditor for Wipro, and Wipro provides web-based services or IT-based services to KPMG. A hypothetical scenario, I'm just explaining. It's not that this particular example existed. Okay, let's assume the audit fee of KPMG is 5 crores and Wipro charges 3 crores for the web-based services to KPMG. Now, both from KPMG's point of view and from Wipro's point of view, the other party is a customer. I have 5 crores revenue from KPMG's point of view and 3 crore money that was paid back to customer. 3 crore revenue and 5 crore expense that was paid to KPMG from Wipro's point of view. So what should be the geography of P&L in which this particular payment back to the customer be recognized in the books of account. Look at the exceptions. Audit services and web-based services or IT-based solution services are not one and the same. I am obtaining a clearly separable, identifiable service from the other party. So 5 crores of revenue for KPMG, 3 crores of expense are not one and the same. One is expense, one is revenue. On the other hand, let's come to our business. Generally, you will enter into some sort of advertising deals with your customers, some sort of marketing arrangements with your customers, where customer does some marketing related services to you and he charges some money back to you. Now that money paid to customer for marketing related services, is it reduction from revenue? Simple question. Can this service be offered by anybody other than the customer? Put this simple question to yourself. Can this service be offered by anybody other than the customer? If the answer is yes, you have an argument to say it is a separable service. If the answer is no, it is like coordinated advertisement or cooperative advertisement. Whether you take it or don't take it, I am going to advertise this particular product and you are going to pay me so much amount of money. Another example, when you go to any supermarket, generally you can see where dairy milk or your mints can be found when you are actually getting your billing done. These are called slots. So let's assume dairy milk guy supplies to Ratnadeep at a particular value, and Ratnadeep in turn charges dairy milk or whatever the Cadbury for the slot that has been given to him exclusively for selling the dairy milk product. So that means I am obtaining revenue and I am paying him slotting fee. Is it reduction from revenue? Simple question. Can the slot be offered by anybody other than Ratnadeep? What will I do? I am selling the product to Ratnadeep. There is no point for me sell the product to Ratnadeep and book some slot in Vijayata, right? Or in Heritage. I need the slot in the same Ratnadeep where I am selling the product. So the service cannot be offered by anybody but for the same customer. Same thing applies to Vijayata also. Say for example, I am selling the product to Vijayata, I am selling the product to Ratnadeep, I am selling the product to Heritage. And in all the three, I have a slot, specific slot where this particular dairy milk has to be positioned so that I can create the demand. And once you do that, obviously it is the same customer who can offer you that marketing service. It is the same customer who can provide you the danglers. When you go to Pepsi in a particular showroom, there will be some Katrina Kapoor danglers, right? Only the person who is selling Pepsi can have those danglers. I mean, otherwise it does not make any sense. So although it appears to be on paper that I'm obtaining a separate marketing service, I'm obtaining a separate advertising service, no. It is only and only a service that can be obtained from your customer. There is no selling of product to one party and selling of advertising services to another party if that is not possible for you, or contractually that is not possible for you. It is reduction from revenue. Very, very important point. That's it. Now, allocate the transaction price to performance obligations. So you have a contract with customer, you combined it with another one, you identify 10 promises, it became 5 performance obligations, and you determined some transaction price, including the variable consideration principles. You applied all the other, wherever that allowance for sales returns and all that stuff. Now, there is X amount of transaction price and 5 performance obligations. The next step is, how should that X be allocated to each of these 5 performance obligations? Mark my words, I'm not using the word promises. Your money collection from customer can be based on promises of 10 incorporated in the agreement, but accounting has to be vis-a-vis these performance obligations. I have 5 performance obligations and I will be getting X amount of money. Let's assume for the time being that X is 10 lakh rupees or 1 crore. So this 10 lakh rupees has to be allocated to each and every item. How should I do it? Simple, in proportion to their standalone selling price. What do you mean by standalone selling price? Are you offering this particular service independently? Here I have a bundle, 5 performance applications. Are you offering this particular service that, okay, one performance application at 20,000 rupees, second performance application is at 40,000 rupees. Are there any independently, are these being traded independently by you? If yes, in the ratio of 20:40:50:50, whatever it is, please allocate that. No, boss, there is no concept of offering these services independently. No worries. Measure the independent standalone selling price. How do I do it? Predominantly, there are 2 approaches. Although standard says there are 3. The approaches are adjusted market assessment approach. That means if there is a competitor who is offering this particular service to you at a particular price, so I can take a comparable price. Second one, cost plus reasonable markup approach. Here, cost of your company, markup of the market will be considered. Either of these 2 approaches will be followed for 1, 2, 3, 4. For 5th performance application, you are left with nothing. You can use a residual approach. 100 minus A plus B plus C. You will get D as a value for residual. So predominantly there are 3 ways of identifying standalone selling price. If already standalone selling price is available, yes, please allocate in ratio of that particular standalone selling price. If not, identify the selling price, standalone selling price, by using either adjusted market assessment approach or expected cost plus margin approach. Then use basically if there is nothing possible, you go for a residual approach. That does not mean for 5 performance applications, I will identify market assessment approach for 1, for balance 4 it is residual approach. No, it can be only for 1 of the many performance applications you have. You can go through the example. I am skipping the example. Next, I'll go through the main content. We have seen, right? There is something called transaction price. Sorry, there is something called fixed consideration as well as variable consideration. The variable consideration can be plus or minus. It can be in the form of a discount, or it can be form of additional money that can come. Let's assume there is a discount in the composite contract. These 5 performance obligations has some discount that is being offered by you over and above the contract price. Say, for example, the whole contract price is 10 lakhs and I am offering you 1 lakh discount for A, B, C, D. Now, the question is, should this 1 lakh be allocated to all, or should it be allocated to only 1 or 2 performance obligations? The answer is pretty simple. If nothing is specified in the contract, it should be allocated similar to all the other consideration. Even the discount has to be allocated to all, except in a particular scenario. I'll explain that in the form of an example. Maybe you will be able to understand it better. Let's assume Airtel is offering you the following program. Because if you take 5 SIM cards from me, and if you take broadband connection from me, and if you take landline telephone connection from me, and if you take D2H connection also from me, the entire package for a year is 20,000 rupees. Brilliant. Can this be offered by anybody else? Of course. I have Act Fiber, I have BSNL landline, I have Videocon D2H, and I have an Airtel mobile. So all 4 can be supplemented by any third-party market participant. So all 4 are distinct performance obligations. So 4 performance obligations, 20,000 rupees is the value. Now this 20,000, he said, sir, some Ganesh Chaturthi offer is going on. I will give you in 18,000 rupees. Now 2,000, should I be allocating it to all 4? Or should I be looking at something else? Because Airtel guy is more known for his business in SIM cards or in a way broadband connection. Let's assume that he independently offers one or two connections on his own. Let's say, for example, there is one more package which is broadband connection and landline connection, which is like this: 5,000 rupees per annum, and offer price is 2,700 rupees. I repeat, 5,000 rupees, offer price is 2,700. Meaning the discount for a bundle of broadband connection and telephone connection is 2,300, and the discount in this consolidated package is 2,000. Meaning he is not offering any discount for the balance two services. Whatever the earlier bundle has to offer to you, the same discount he is extending it even here. In fact, he is reducing it here. So what the accounting standard says is the discount should go only for those two performance obligations. Don't offer any discount for any of the balance performance obligations. Hope it is clear. I'm jumping the gun. You can follow the example. That is different from what I have explained to you. Allocating the variable consideration. I will skip this particular section because I have skipped one more slide called sales-based or usage-based royalties. It makes absolute sense, and there is one very good example when once you understand these two slides. But given the paucity of time, I have to skip it because I will not be able to cover other positions. So pardon me for that. Next, recognize as and when the entity satisfies the performance obligation. Look at the language little keenly. I have a contract with customer. I have combined it with another contract, identified 10 promises, which became 5 performance obligations, determined 10 lakhs as a transaction price, allocated the entire 10 lakhs based on standalone value of these promises, offered whatever the discount that has been offered has been allocated to only 1 or 2. Now, I have to recognize revenue as and when these performance obligations are carried out. Now look at the language. Recognize when the entity satisfies a PO, means performance obligation, not purchase order. So recognize revenue when the entity satisfies performance obligation. Means after completion of the activity, you will recognize revenue. Now don't read the word when, read what is there in the brackets. Recognize revenue as the entity satisfies performance obligation over the period of revenue, over the period of time. So the fifth point is timing of recognition of revenue. Is it point in time or period of time? Point in time is after completion of performance obligation. Period of time is over the period, where the guidance has been given by the accounting standard. Accounting standard first starts with a harsher position. Just see whether revenue can be recognized over a period of time. It can be viewed in both the ways. It can be a harsher point of view, or it can be said that, okay, I can recognize over a period of time my entire revenue. But sometimes, you know, people are more and more interested in bullet recognition rather than deferred recognition of revenue, or attribution models of revenue. Now, what is the guidance that accounting standard has given for over the period of revenue? It says in the whole contract, now see, for 3 conditions, if either of the 3 conditions get satisfied, then you have to recognize the revenue over the period. What are those 3 conditions? It's not all put together. Either of the 3 conditions that get satisfied. What are those? Very, very meticulously drafted. Each one has one particular importance. As and when the entity performs the service, consumer also receives the benefit symmetrically. Example, very crude: security services, cleaning services, transaction processing services, invoice processing services, software licensing services. Predominantly servicing industry gets covered here. One invoice processed by vendor is one invoice processed for customer. One floor cleaned by vendor is one floor cleaned for customer. One day hotel management services are rendered by vendor 1 day hotel management services are received for customer. So there is a symmetrical receipt of service as and when offered by the vendor. I have a contract for 50,000 liters of water to be supplied by GHMC on a daily basis. For 15 days, I received 50,000 liters. For 15 days, 50,000 liters of obligation has been performed by GHMC. In such circumstance, revenue has to be recognized over the period. The monthly transaction processing fee, monthly payroll processing fee has to be recognized over the period of month. Similarly, yearly contractual fee has to be recognized over the period. If not, look at the second example. Entity's performance created an asset which is controlled by the customer. Classic case of example for infrastructure industry. I have an agreement for construction of a bridge. Bridge half constructed is half constructed. Who can control? Entity. Customer can see the bridge. Customer can control the usage of the bridge. If there is any possibility, I can control, or I can stop, or I can do. Sometimes it is not possible for you to say that half finished work is half finished for other. Best example is, say for example, a CA related services or a lawyer related service. You have taken up a case and say for example, which was, let's assume you are a Supreme Court lawyer, some customer, some plaintiff or some defendant who has come to you, who has lost the case in High Court, has approached you. Will you read the case from the beginning, or will you read the case which was left over from High Court case? If you read it from High Court case, you will eventually lose. Obviously, you will start reading the case from the beginning. Classic example of saying whether the asset is of any use for the customer or for the vendor or not. Here, you being a vendor, a service provider, whatever the service that you are offering is of, that means whatever that High Court lawyer has offered to you is of no use for another service provider. Another way of saying whether it has any value to customer or not. Third one, predominantly pharmaceutical industry and telecommunication industries come here. Entity's performance does not create any asset. You have transferred an intellectual property to the customer. It does not create any asset to you, or you have offered some R&D services to your customer. It does not create any specific asset to the customer where it has an alternative use. But the most important thing, the entity has an enforceable right for payment, not a success-based milestone payment, but a payment for the work done. If somebody is seeking R&D services from me, irrespective of the failure or success of that R&D service, he is compensating me for the efforts done. Say for example, Dr. Reddy's did some phase 3 clinical studies for Sputnik vaccine. If RDIF of Russian government is compensating Dr. Reddy's for each and every study conducted, irrespective of the outcome of Sputnik's efficacy on Indian population, it is entity has a performance, entity has a right for the services that it has offered to RDIF. So there is no asset here. There is no tangible asset because nothing has got established with respect to Sputnik when the trials are going on. But Dr. Reddy's is compensated for the work that is being done, not based on success. Only if Sputnik is successful on Indian population, I will pay you. Then I will not take the contract. So, depending on your industry, cherry pick which particular item applies to you. That is the reason why standard did not say all the conditions to be satisfied. It said any of the conditions, if satisfied, would result in over a period of time. No, nothing has satisfied. What should I do? Just wait. If you have received any non-refundable upfront consideration, keep it as an advance. Complete the performance obligation and recognize at the end of the period. So if it is not over the period, it automatically falls back to a position that it has to be recognized at the end after completing the performance obligation. So now, just in between, I forgot how to determine over the period. Now, what is the revenue attribution model? It can be output-based model or input-based, which is cost. which is predominantly the same thing which we had in AS7 or under Ind As 11. Your output-based model is where the percentage of completion is determined by surveyors. Input-based model, cost incurred till date divided by total cost to completion. Same thing, you will arrive at a percentage. Based on percentage of completion method, you will recognize. This fits majority of the industries, but not all the industries and all the companies. As I said, pharmaceutical industry does not absolutely gel with. So if I have to do any R&D service, I will be more so interested in result of the service. Okay, I have completed 80% of the testing. What should I do? 80% of completion of testing is as good as not done. So complete the service, show me the result, then I will show you whatever that is payable to. Okay, control satisfied. If it is not over the period of time, it has to be satisfied at the end of the point in time. Some of the pointers are like, you must have parted away with your transfer of goods. You must have parted away with the control. You must have had a right of receipt of money for the completed activity, and customer must have accepted the point. These are predominantly the fundamental steps, 5 steps. Now going to some of the case specific points. If there is any repurchase agreement, that means you are selling the product. At the same point in time, you have another contract to purchase the stock unconditionally, then it is as good as no revenue transaction. Repurchase transactions are nothing but what we have seen as transactions lacking commercial substance in the scope paragraph. That repurchase can be either in the form of an option or in the form of obligation. Even an option, does it create an obligation? Yes. Immediately I am drawing a reference. Ind As 32, which explains financial liability, paragraph 25. If any amount is payable contingently on happening of A or B, it is still a liability. So you can't recognize whatever the money that is received by you, even though it is optionally payable, contingently payable back to customer. The money received is under Ind As 109, it is liability under Ind As 32, not 109, it is under Ind As 32, paragraph 25. That is what another example for in scope paragraph, transactions falling under Ind As 109 are not covered under Ind As 115 means. You can take either that kind of an example also, where consideration received by you is optionally payable back because of your repurchase agreement. Then it is a liability, not revenue. Bill and hold, the transaction has got changed, accounting has got changed. In case of bill and hold transaction, I am keeping aside all the other requirements that there is a genuine request from the customer to hold the stock and not to transfer the stock immediately. You will end up now having an accounting in 2 entries. First entry for completion of manufacture, second entry for holding the stock as a custodian for the specified period. So whatever that 100,000 or 200,000 money he gives you for the contract has to be separated between 1,80,000 towards manufacturing services, 20,000 towards custodian services to be recognized over a period of time. 1,80,000 is recognized after the completion of manufacturing activity. 20,000 is recognized over the period of offering those warehousing services or custodian services. It's not exactly 18:2 kind of stuff. I just have taken it for example. Now, this accounting standard also talks about costs. Cost to acquire a contract. In case of revenue, if there is going to be any revenue contract and to obtain the contract, you have paid certain costs. Then you can recognize that particular cost on the balance sheet and recognize the depreciation over the period of the revenue contract. Say for example, you will sometimes in a revenue contract, you will pay liaising fee or scouting fee to the party who has given you that contract. Then it is possible for you to acquire the contract. That scouting fee has been paid and it is because of that fee I have received this revenue contract. So capitalize it and recognize it over the period of the revenue. Cost to fulfill the contract, as simple as your COGS. It can be manufacturing cost, labor cost, overheads, cost of service, cost of consumables, everything. To fulfill the cost you are incurring. Now, most important thing, don't try to use the matching concept here. Under Ind As and under IFRS, for that matter, very specific, there is no concept of matching. Two principles which are outside Ind As perspective are, there is no concept of prudence. Under IAS 37, you can't provide for provisions left and right, ad hoc provisions, no. Only if the estimate can be made reliably and in a best possible way. Best reliable estimate, you will make a provision. No concept of conservatism stays in IFRS or in Ind As. Similarly, no concept of matching. Because revenue is not recognized, I will put these costs in balance sheet. No concept, no such concept. You can't put anything on balance sheet. I have understood one crude way of learning accounting standards. I'll explain you, maybe it will be of some use. There are two principles of accounting. Whatever spent by you is a charge. Whatever received by you is an income. You might be thinking in your mind what nonsensical statements you have made. Whatever spent by me need not be a charge. It can be having an enduring benefit and hence has to be put on balance sheet. Brilliant. Now, imagine whatever the statement I have made, whatever spent by me is a cost. Exceptions to it are all accounting standards. There are no accounting standards for expense. There are always accounting standards for assets. So either it can be a property, plant and equipment, it can be an intangible asset, or it can be inventory, or it can be a financial instrument, or it can be an asset held for sale. Imagine, exception to a statement that amount spent by me is a charge of our accounting standards, meaning only if you can relate it to any of the provisions of these accounting standards, the amount stays on balance sheet. There is no entity, there is no accounting standard for COGS. It is only inventories. There is an accounting standard for research and development expenditure. It is only intangible assets. There is no accounting standard for research, repairs and maintenance cost. It is property, plant and equipment. Likewise, if it meets the exceptional criteria, can be put on balance sheet. That's the reason why no accounting standard tells you when to charge off the amount to balance sheet. It only tells you when to put it on balance sheet. Sorry, when to charge off the amount to P&L account. It only tells you when to put it on balance sheet. Only if it meets that criteria or criterion, you can put it on balance sheet. Similarly, whatever I have received is income. What nonsense, it can be liability also. Liabilities are defined under IAS 37. It can be revenue. Revenue is defined under Ind As 115. Otherwise, it is income. So gratuitous payment received is income. It has to be payable. Yeah, financial liability has its own fangs, its own elaborate positions that have been explained under the accounting standard. That's a separate thing. But if it falls only in a particular account, exceptional mode, it can be considered as a particular thing. Otherwise, there is don't unnecessarily create confusion in your minds or create clutter in your mind by including the provisions of matching and then say, because I am not recognizing revenue, I will put this amount till the time the service contract is delivered. I will put cost incurred on the service on balance sheet. Not even a single line in the entire 41 accounting standards will support this base of yours. There is nothing of that sort. That's it. So disclosures part, yeah, I will put on hold. Very easy for me to say whatever I have explained so far has to be disclosed. It's not that way. Laborious disclosures it has got. But yeah, given the paucity of time, yeah, I've already busted out successfully and I have kept up to my reputation. Now I'll stop here. I don't know whether I've made any sense or not. Now with again appreciative note that for giving me this opportunity, I will hand over the mic back to Deepak sir and Amachar Rao sir. Thank you.
Thank you, sir. An excellent in detail presentation. Whether it doesn't make sense, but you are saying you have not made sense, but I am saying that you have made a lot of deep diving in the subject, and we are very blessed to have that knowledge getting grasping in last 2 hours. I'm sure the members would have got benefit of, sir.
Thank you. Thank you. If there are any questions or any doubts, I would like to take if they have patience.
Yes, sir. Actually, 5 questions have come in the Q&A, sir. Actually, you are reading, you are actually talking for more than 2 hours. If you want, you can have a sip of water, then I'll just read out the question for the benefit of the members because they'll not be able to see the questions. So, first question is from MV Ramnamurthy, sir.
Yeah, I can see it basically. Let me read out. In construction contracts, there could be cases where contractee has certified irrespective of fulfillment of performance obligations. In such situations, deferring revenue has some challenges since contractor could have deducted GST and income tax TDS, and based on this, the authorities would not consider deferring the revenue for tax purposes. Point taken, but let me give my views, my independent views. Accounting is completely agnostic of views of taxation and views of indirect taxation with relating to this particular point. Non-refundable upfront amount can be revenue for many logical minds or for many authorities as such. But unfortunately, like how it is said, it is not revenue under accounting standards, may not fit the bill. Maybe in your case, if the answer were to be that if it does not meet the recognition criteria, if it cannot be a revenue under this particular position, might be little harsher for you. Just to give you an analogy, see, the definition of export is when once the product crosses the territorial waters of India, if it is our territorial airs of India, it is an export under some regulations or some indirect tax regulations. But unless and until control is transferred, it is not revenue under Ind As 115. There we are able to decipher a position that although it is an export under one tax regime, it is not an export under accounting regime. So may or may not be possible that, so to put it to you, sorry, the question has gone.
So it is here.
Yeah, fine. Okay. Anyways, I have read that question basically. So it is like, it may not be the case that it might look odd for you that in your tax returns or in your GST returns, it might consider as a revenue, but it can very well, jolly well can be a position that it is not revenue under accounting system. Let me be very honest, absolutely zero knowledge about GST and taxation, but decent to an extent. I have some knowledge about accounting. So I'm not surprised with these kind of instances. I've seen enough number of instances where accounting revenue is zero, where other revenues in other forms is X amount. In a contract for leasing an immovable property, now, see, of course, I'm not reading the full line basically. Of course, fine. Let me first read it basically. Contract for leasing the immovable property means you always have to go to Ind As 116, especially if you are going as a lessor. I presume that it is definitely from lessor's point of view, not at leasing. It is a scoped out position. You need to evaluate the transaction under Ind As 116. But that said, let me read. Immovable property for its entire useful life, the entire consideration is received upfront, and all major risks and rewards are transferred in favor of the lessee. Whether this contract shall be treated as an equivalent to sale and provisions of Ind As 115 applied? No, you are not referring to a appropriate accounting standard is the answer. It would go to a position called Ind As 116, evaluate it from a lessor's point of view. The position was not changed. It still goes by operating lease or a fair value lease or a financial lease, meaning capital lease. If it is capital lease, yes, you can de-recognize. Otherwise, you will not de-recognize. You will recognize it only over the period of time. Adding to the above query, there are no pending performance obligations left to be fulfilled by lessor. As I said, don't intertwine Ind As 115 and Ind As 116. Ind As 116 has its own way of evaluating a leasing transaction. So it does not fall under 115, it falls under 116. My view. Maybe unless I see a transaction or maybe some more points come to me, a position might change, but as I see it, it is clearly an Ind As 116 transaction. In case of power projects which are constructed over a period of time, if equipment is procured from various sources, when is the revenue recognized? As individual equipment procured is not useful to customers. Sir, your question itself has an answer. If My object is to complete the completion of power plant and hand it over to customer, rather than going through standalone useful value to customer. Fine, it does not have standalone useful value. What does it mean? Meaning your performance obligations are not distinct, but don't use that criteria for the purpose of recognizing revenue. For recognizing revenue over a period of time, you have three conditions. As and when the asset is created, if the customer can control the asset, as and when the services are offered, customer can receive the benefit. There is no alternative benefit, but I have a right of compensation. If either of these three conditions satisfy, as I read it, these 4 lines, points B and C appear to have satisfied for me, and I believe that in your case you have a case for recognizing revenue over a period of time. Not that after, it's not that standalone value. Standalone value evaluation is to see whether the performance obligation is distinct or not, or it has to be combined with others. Assuming that you have a one performance obligation of completing the plant, you can still recognize the revenue if you have a right of reimbursement for work done, or you have created the half-finished power plant is completely under the control of your customer. Sir, everything got deleted and there is only one thing is there. How about the timing of revenue recognition with respect to?
Sir, it is actually half part has come in key chat box, sir. 1 second. How about the timing of revenue recognition with respect to HAM contracts, road projects? NHAI pays 40% during construction and balance 60% in 15 years. 30 semi-annually. I am the contracting company. When shall I recognize the 60% revenue?
Not very clear, sir. Basically, I am confused between whether it is, public-private partnership contract. That is, or whether it is, I need some more details for that. So, I'll take, maybe an option of not having full knowledge of the question. Basically, rather than giving me, I would rather say I don't know the answer rather than say giving a wrong answer. Basically, kind of. I know Appendix C to Ind As 115. Then, sir, I have not covered Appendix C here. It is service concession arrangements. Service concession arrangements, that's the reason why I said it is public-private partnership kind of an arrangement. If that is the case, these are not the principles. Service concession arrangements has a separate literature, as it has been rightly mentioned by you. I need to have either create a financial receivable or an intangible, and depending on the amount of collection, I will recognize it over a period of time. So again, I would probably better reserve my answer by saying that maybe I need some additional details to say that whether it can qualify for financial receivable and to what extent, and what are the monies that you would get it from the public, and then probably can evaluate the whole answer. To give you a very, very loose answer, yes, Appendix C and whatever we have discussed so far are not one and the same. Frankly speaking, I'll appreciate for raising the question. I should have covered it in the initial paragraphs itself, that my presentation does not cover service concession arrangements. Yeah.
Thank you, sir. Sir, you can close your share screen, sir.
Okay, just a second. I'm unable to. Yeah. Yes.
A small token of appreciation from Hyderabad branch for a wonderful presentation on Ind As, sir. Kindly accept it.
Thank you.
Once again, a very thank you, sir. I, on behalf of entire managing committee of Hyderabad branch of ICI, thanks CA Naga Babu Sudhakar, sir, for his excellent presentation. Sir, your presentation was very comprehensive. Many members have asked for the presentation copy. I request you to kindly share it with us, sir.
Yeah.
We will definitely host on the website. I also thank all the members for their active participation and being important contributory to the program. Any program does not become successful with the audience attendance and participation. We thank you once again for being with us today. our next program is a very wonderful on a hot topic. That is a 5 days program on advanced issues in GST, which is a practical oriented and which our members are facing on day to day. The next, it is a program of 5 days starting from 16 to 20th of August next week. The details has already been hosted on the website. We request you to kindly register and oblige with your participation. Thank you once again. Thank you, Sudhakar sir. Thank you.
Thank you. Thanks a lot for the opportunity. I think I've made some sense. Whoever has the questions, I don't know whether my details are there or not. Probably you can touch base with either of the, institute for the details if you have any doubts. Otherwise I'm privileged, in fact, for the opportunity. Yeah.
Thank you, sir. We need more sessions from you during the course of time.
Absolutely. I leave it to you. You tell me. You want me to talk on another standard right now? I'm ready.
So kind of you, sir. So kind of you. Thank you, sir.